In recent months, there has been growing economic tension between the United States and Japan over the value of the Japanese yen. As the yen continues to weaken, concerns have been raised by the U.S. government about potential currency intervention by Japan. This has led to a warning from the U.S. to Japan, urging them to refrain from manipulating their currency. But why is the U.S. so concerned about this issue? In this video, we will delve into the current yen crisis and explore the reasons behind the U.S.'s warnings over currency intervention in Japan. Understanding the basics of currency intervention. Currency intervention is a policy action taken by a country's central bank or monetary authority to influence the exchange rate of its national currency. The goal is often to stabilize or adjust the currency's value for economic advantages. There are two main types of intervention: direct and indirect. Direct intervention involves the buying or selling of the country's currency against another currency, usually the dollar, to move the exchange rate in a desired direction. For example, if a country wants to weaken its currency to boost exports, it might sell its currency in exchange for foreign currency, increasing the supply and thus lowering the price. Indirect intervention, on the other hand, can involve altering interest rates or setting monetary policy that impacts the exchange rate indirectly. These interventions can be controversial, as they can lead to competitive devaluations and affect global trade dynamics. Countries engaging in such practices may face criticism or warnings from other nations or international bodies concerned about the fairness and stability of the global economic system. The origins of the yen crisis. The origins of the yen crisis can be traced back to a combination of domestic and international economic pressures. Domestically, Japan has been grappling with decades-long deflationary pressures, an aging population, and sluggish economic growth. These factors have compelled the Bank of Japan to maintain ultra-low interest rates and engage in extensive quantitative easing measures. Internationally, the global economic environment, marked by trade tensions and uneven recovery patterns from the COVID-19 pandemic, has further complicated Japan's economic landscape. As major economies like the U.S. begin to recover and signal a move towards tighter monetary policy, the disparity in economic strategies has led to increased volatility in the currency markets. The yen's depreciation is not solely a product of Japan's internal economic policies, but also a reflection of the strengthening of the dollar as investors seek higher yields in the U.S. This dynamic has placed significant downward pressure on the yen, contributing to the crisis and drawing international scrutiny over Japan's potential response through direct currency intervention. Why the U.S. is concerned about Japan's currency moves. The U.S. harbors deep concerns about Japan's potential currency intervention due to the significant repercussions such actions may have on the global economy and specifically on U.S. economic interests. When a country like Japan attempts to devalue its currency, it can make Japanese exports cheaper and more competitive on the global market. This scenario poses a direct threat to American manufacturers and exporters, potentially leading to a trade imbalance that disadvantages U.S. industries. Furthermore, deliberate devaluation of the yen could spur other nations to engage in similar competitive devaluations, risking a currency war where countries compete to lower their currency values, thereby destabilizing the global financial system. The U.S. also views the stability of the yen as vital to the broader economic and financial stability of the Asia-Pacific region, which is a key market for American goods and services. Additionally, abrupt currency moves can disrupt financial markets, affecting investors and companies worldwide, including those in the U.S. Hence, the U.S. warnings to Japan reflect a combination of protecting domestic economic interests and maintaining the overall health and stability of the international financial system. Potential impacts of continued currency intervention. If Japan persists with currency intervention, it could exacerbate tensions with trading partners, leading to retaliatory measures and potentially igniting trade wars. Such developments may undermine international economic relations and disrupt global supply chains. Continuously manipulating the yen could also distort financial markets, affecting investment flows and possibly leading to volatility in global stock and bond markets. Longer term, These interventions risk eroding investor confidence in Japan's economic policies, making it harder for Japan to attract foreign investment, essential for its economic stability and growth. Historical context of currency wars. Currency wars, also known as competitive devaluations, have a storied past, shaping global economic landscapes. Notably, during the 1930s, countries devalued their currencies to boost exports during the Great Depression, exacerbating global economic instability. More recent examples include the 2010s, when countries like China were accused of manipulating their currencies to gain trade advantages, leading to heightened tensions with trading partners. These historical instances demonstrate the potential for currency wars to disrupt international trade and economic relations, underscoring the precarious nature of unilateral currency interventions on a global scale. Japan's defense of its currency practices. Japan has consistently defended its currency practices, emphasizing that its actions are aimed at combating deflation and promoting sustainable economic growth rather than manipulating the yen for trade advantages. Japanese officials have argued that their monetary policies, including quantitative easing and maintaining low interest rates, are primarily focused on domestic economic challenges, such as an aging population and stagnant wage growth. They contend that any impact on the yen's value is a byproduct, not the objective, of their efforts to revive the economy. Tokyo has also highlighted its adherence to G20 and G7 commitments, which allow for monetary policies directed at domestic objectives, as long as they do not aim for competitive devaluations. Furthermore, Japan has pointed out the importance of stability in the exchange rate for Japanese businesses and the global market, suggesting that any measures it takes are in line with ensuring a predictable economic environment. By framing its currency practices within the context of these broader economic goals and international commitments, Japan seeks to counter criticisms and justify its policies on the global stage. The role of international agreements in currency practices. International agreements play a crucial role in governing currency practices by setting guidelines that discourage competitive devaluations and promote economic cooperation. These agreements, forged under the auspices of organizations like the IMF, G20, and G7, aim to ensure that countries adopt currency policies that support global economic stability rather than pursuing short-term national advantages. By participating in such agreements, nations commit to transparency and cooperation in their monetary policies, helping to mitigate tensions and prevent the adverse effects of unilateral currency interventions on international trade and economic relations. Navigating the future. Possible resolutions and outcomes. Moving forward, possible resolutions could involve diplomatic negotiations and enhanced cooperation between Japan and its trading partners, including the U.S., to address concerns about currency manipulation. Strengthening international frameworks for economic policy coordination might offer a pathway to resolve tensions while ensuring global market stability. Additionally, Japan might seek to reassure the international community by being more transparent about its monetary policies, emphasizing their focus on domestic economic issues. Ultimately, the resolution lies in balancing national interests with the imperatives of global economic stability, aiming for outcomes that avoid trade wars and promote sustainable growth. Thank you for tuning in to our exploration of the economic tensions between the U.S. and Japan regarding currency intervention. If you found this video insightful, please give it a thumbs up and consider subscribing to our channel for more in-depth analysis on global economic issues. We'd love to hear your thoughts on this topic. Do you think the U.S. warnings will impact Japan's economic policies? Share your opinions in the comments below. And don't forget to hit the notification bell so you won't miss our next video. Until then, stay informed, stay curious, and keep exploring the world of economics with us. See you soon.